Argentina is a wonderful example of what happens if you follow the wrong course, because a century ago it was the third wealthiest country in the world. It was as wealthy as France, it was wealthier than Sweden and Norway. Even as recently as 1950 it was still one of the top half dozen countries in the world in terms of income per head. But bad governance, bad policy has resulted in it ending up being not even an emerging market, because it was actually downgraded by MSCI to frontier market status in 2009. It also incidentally had the biggest default on its foreign debt ever back in 2001, you may remember, Al, until Greece did the same thing last year, and it looks like they might default again. So it's not to say that frontier markets or emerging markets follow an upward path that's always going to be in a straight line. In fact, there's lots and lots of volatility. Right. But one of the interesting things I think we found was that even though the frontier markets are volatile themselves, because they don't move in the same direction as the developed markets or even the emerging markets, by putting a little bit of frontier markets into your international portfolio, you'll reduce the overall volatility. So even though you are a volatile market like Nigeria or Argentina or United Arab Emirates, the fact that you zig when the other markets sag actually ends up with lower volatility for the overall portfolio. So even if our thesis about them repeating what the emerging markets have done over the last 10 years doesn't end up to be correct in that time frame, it's still worth having frontier markets in your portfolio because they reduce the overall volatility.
Yeah, and we need to explain that the overall volatility is a function of all of the volatility levels of all of the assets in your portfolio.
Yep.
And in an ideal world, they're not all volatile at the same time in an ideal world.
Absolutely, which is why you always traditionally had bonds and stocks, because bonds, A, were less volatile than stocks, and B, tended to move in a different direction from stocks, so that by having that mixture, you had something which had good risk-return characteristics. The difficulty these days, of course, Al, is that with interest rates being so low for bonds, first of all, their ability to dampen down the volatility is much lower because the amount of return you get from income is much lower. And secondly, they're tending to trade more like stocks because the income levels are so low. So frontier markets are actually one of the very few asset classes left that are not correlated with the major asset classes. So they're a very attractive volatility reducer for portfolios in general.
And let's explain that correlated means that they don't necessarily move together.
Absolutely.
So that if we say that one asset class is not correlated with another, what we mean is that the one is going up or down. It doesn't mean that the others are going up or down at the same time.
No, a perfect correlation would be 1.0. So if something had a correlation of 1.0 with something else, it would move exactly in line. And interestingly, the emerging markets, which used to be a good reducer of volatility in the way that frontier markets still are, had a correlation of less than 0.5. Today they have a correlation of 0.9 with the major developed markets.
Which means almost even.
They all move almost in line.
Right.
Whereas frontier markets are less than 0.3.